The credit crunch explained. This is a talk about the credit crunch. I'm sure everyone has heard quite a bit about it in the media and so on. I'm going to try and give a broad overview of what the hell the credit crunch is, why it happened, and what's likely to happen in the future. So I'll start by giving a brief history of capitalist economics to put it into context. Then I'll look at neoliberalism, which is the sort of the most recent sort of flavour of capitalism. How that led into the crisis of 2008 and how the crisis is likely to shape the future. So to start with just to look at this is looking at capitalism from its own terms. No one really believes that capitalism, the market is perfectly efficient or anything like that. It's been well understood for a long time that there's structural failings built into capitalism. Firstly, that the short-term focus predominates, externalities are ignored in general, and competition in a strange way forces conformance. All of this stems really though from a basic human tendency to overestimate stability and underestimate risk. People are again and again shown to be prone to that. And when it comes to how this manifests itself in capitalist economies is that you get a boom and bust cycle. Looking at the first point, capitalism short-term bias. Now this is basically basically it comes down to it. Managers of big institutions, they are paid largely in bonuses. Their bonuses depend on immediate profits, and so that tends to motivate them. Owners and shareholders are also after profits. And it's normally the way the corporate accounting works. Quarterly profit is the metric that most people focus upon. At 3-month chunks, how profitable we were then. That's what corporations typically tend to focus on. Now, when we look at externalities, what do we mean by that? It's any costs of an industry that can be externalized, will be externalized. This is basically the idea that dealing with the consequences, the broader consequences of companies' actions, that's somebody else's problem. So for example, you could have a business that causes environmental degradation. That doesn't appear on your balance sheet. It's just somebody else's problem. Now, when you have one company acting like this, basically irresponsibly, that's a problem. But when everybody's acting like that, then you can get very big problems being built up that nobody is addressing and that are going to cause the whole thing to collapse at some stage. It's also, capitalism has in it a sort of a sense of a race to the bottom. Basically, if you don't take advantage of opportunities for short-term profits, your competitors will. And so you can't decide that my company is going to be really environmentally responsible and so on and get a less profit, because you'll make less profit, and the extra profits that your competitors make, they might just turn around and buy you. There's very little space for bucking the trend and being less profitable than you could be. People are generally pretty bad at estimating risk. You can run all sorts of psychology experiments and stuff like that. People tend to underestimate risk. They tend to think people are sort of inherently optimistic about the future, and they tend to assume that things that have been the same for long periods of time will remain the same. So for example, if your interest rates over a long period of time remain low, you can borrow easily, people will tend to assume that that's going to be the same for the future. They won't build in the idea that they could suddenly change. Okay, so all of these combine to make capitalism as a system inherently prone to cycles of boom and bust. People being too optimistic, focusing on short-term things, ignoring long-term problems, ignoring things that are outside of their balance sheet. This all means that capitalists rush into business opportunities beyond rationality, and then they see them collapse. And this is a regular cycle. So if we look at some of the historical examples, some of the earliest capitalist crises we know of, first of all, in the very early years of capitalism, when the sort of banking system was just and credit systems were just getting off the ground, in Holland in the 17th century, they had tulip manias. Now, tulips, in today's prices, at one stage, tulip bulbs were going for like 100,000 in the Dutch mercantile exchanges, and then they just collapsed. The British South Sea Bubble, another good example. There was a company set up by the British government and given a license by the government to trade with South America, and a whole load of money poured into this. People thought there was untold wealth to be tapped there. It ended up just collapsing again. It was a bit of a scam by the government, actually. Then the period of the 19th century, sort of from 1830 to 1914, was the real period when capitalism had become the dominant system. You had with the Industrial Revolution, you had the intensification of production, you had a lot of imperial exploitation going on, a lot of wealth flowing into Europe from the Third World. You had the extension and expansion of the banking and credit system, which became quite pervasive. The economic system was facilitated by the fact that there was a gold standard. All currencies were basically, their value was linked to the value of gold. You could exchange them for a certain amount of gold, and therefore all currencies were basically interchangeable. So there was no currency problem. They were all essentially equivalent in trading. That allowed international trade to prosper. You also had a big laissez-faire ideology. 19th century liberalism was very much had this sort of mystic faith in the markets. They will efficiently deliver resources to where they can be best used. And a great example of that was the Irish famine, when the British government decided not to intervene in and send food to Ireland, because that would be breaking the markets and cheating, and the market had to sort it out. The fact that millions of people died, that's an externality. So because of all these things, depressions and recessions were very, very common in the 19th century. Like, you had probably about 25 distinct recessions in the United States, and basically because of the laissez-faire ideology and the sort of unchanged nature of capitalism, whenever you got a price bubble, and you got these all the time, new technology, whenever the railways were established in the UK in the 1840s and the US in the 1860s, there was a lot of competition for, because people realized that this was going to be making money in the future. But people ended up building, lots and lots of parallel rail tracks that all went to the same place in competition with each other, and also rail tracks that went useless places that were never going to be sustainable, and so they both collapsed. And then in 1873, with the collapse of the Vienna stock market, the world sort of settled into a long depression, with economic negative growth over and incredible poverty over a couple of decades. So to understand why the 19th century, how these crises could happen, and why the 19th century, so many of them, we have to understand a little bit about the basics of banking. And banking is a business. The basic idea is very simple. You're giving and taking loans. So the basic idea is you try and get your loans cheap and loan them out expensively. Because of the scale of banks, they can take very long-term loans, mortgages typically over like 25 to 30 years. As a system, it works through a thing called fractional reserve banking. This is the idea of, how it works is somebody comes to a bank and puts money in it. Then the bank, as soon as they have that money, they loan it out to somebody else. That money that is loaned out will eventually come back to the banking system, because somebody will put it in another bank account. They loan it out again. So you get a multiplication factor. This shows that the one deposit basically been repeatedly loaned out, and the same money coming back to the bank and being loaned again, up to a factor of 10,000. So, that's a slight exaggeration, but banks tend to have reserve requirements like less than 10% actually, whereby of all the money they've loaned out, they only have actually received 10% of that. A lot of people think that this is a big confidence trick and that the banking is a big scam as a result, and to some extent it is. It all depends on confidence, because what happens when you get a economic crisis, you get lots of companies collapsing, is you get a bank run. This is what happens when people say a bank has made bad investments, that bank might not be economically viable. Lots of people will show up and try and get their money out. And because the bank only has a small fraction of the money that it only ever possesses, a small fraction of the money it has loaned out, it can't pay it, and the bank will collapse. Now, because there's an awful lot of interbank lending, in the 19th century this was pretty much unregulated. Banks would loan to each other. If one bank collapses, suddenly all the other banks have a big hole in their balance books. They have a loan that they can't pay back. Okay, so banking runs, and the importance of the banking system in the 19th century was what caused these sort of bubbles to turn into complete depressions. A lot of banks would collapse and the whole economy would become depressed. So this is the period of our old friend Marx. He was writing in the mid to late 19th century, and the second half of the 19th century he wrote his magnus opus Capital, and it was pretty much an analysis of the capitalist system. Now, as I say, capitalism, we were in a period when capitalism was pretty unchanged, and so Marx, he identified two different types of crisis that could happen to capitalism. Cyclical crisis, which sort of are nowadays often known as business cycles in sort of mainstream economics. But he saw these as being a consequence of the accumulation of speculative fictitious capital, not closely tied to use values. Now what that means is, if you have a share in a company that produces something, your capital is quite closely tied to a use value. It's actually, there's some useful piece of economic activity that you own a share of that capital. However, if you own a share of a derivative that is indexed to the bond rating of that company, there's very little direct connection between your capital and any type of use value. And you tend to, in times of bubbles, get in lots and lots of speculative, fictitious capital building up like a pyramid on top of each sort of actual bit of labour. And Marx's his explanation of these cyclical crises was that, at a certain extent, that amount of fictitious capital would get too great, and the amount, and all sort of resting on the shoulders of individual workers at the bottom, and they couldn't bear it, and the whole thing would collapse. And that's not a bad description, actually, of the type of cyclical crises that we've seen in the 20th century as well. Marx, however, also saw what he called a historic crisis, and this was like the long-term crisis built into capitalism as he saw it. And this is the tendency of the rate of profit to fall. That was one of the central tenets. This is the idea that in any particular industry, if any company has a increase or is more profitable than the competition, it will be copied, and more capital will go into that, and eventually the rate of profit of all the companies will settle down to the bottom level and it will tend to keep on diminishing. And he also saw the increasing concentration of capital as leading to a historic crisis for capitalism. This is the idea that monopolies would build up in lots of industries, and combined with the fact that their rate of profit would be falling, capitalism would stagnate. And the third sort of major thing that he saw as capitalism's historic failing was that capitalism caused the growth of the proletariat. In the 19th century, capitalist economies basically were trying to get peasants off the land and into the factories, but once they entered the factories, they were gathered together and turned into the proletariat. And Marx saw the proletariat as capitalism's gravediggers. So was Marx right, or was he mistaken? Now these three charts basically show, on the top left we have the Dow Jones Industrial Average for the 20th century. We're asking the question here, did the rate of profit fall? Because growth, compounds, it's not actually that clear from that. So the top right there we have the log. Basically, each box represents a multiplication of 10 on the vertical axis. So we can see, for example, from 1940 to 1960, the value of the shareholding in the Dow Jones Industrial Average, which basically is a rate of America's major industry, it increased by a factor of 10. Between 1960 and 1980, it didn't increase at all, really, and between 1980 and 2000, it again increased by a factor of 10. Okay, on the bottom then we have this is the chart of the GDP per capita in the United States and Australia, just two advanced economies, and again we can see that it does not appear to show any variability of rate. Now, so from this we'd have to conclude that in some ways Marx was mistaken. The rate of profit, we can't see it falling over the 20th century. And certainly we can, if you look in more detail, you can see in any particular industry the rate of profit does tend to fall. But what Marx probably underestimated was capitalism's ability to innovate in terms of technology and organisation. So, for example, whereas within any particular industry the rate of profit might fall over time, capitalism invents whole new industries all the time: technology, telecommunications, railways even, and these tend to be very, very profitable, and capital moves there. a lot of Marxists would say, well, it's too early to say, you know, capitalism has been putting it off by sort of extending credit and stuff like that, and there's a certain amount of truth in that. However, any theory that sort of misses out a century, you know, that gets it wrong like that, isn't necessarily that useful. So we'd say, and the other thing that Marx underestimated, he underestimated the inevitability of the proletariat turning or he overestimated how inevitable that was. Capitalism has been able to come up with all sorts of organizational innovations, making everybody a manager in McDonald's, for example, and, you know, human resources departments and stuff like that, to keep the concentration of labor, and also subcontracting, breaking things up into smaller businesses, to keep the proletariat from turning itself into a conscious class. Okay, so after the First World War, we had a period of the sort of pre-First World War global free trade broke down. The sterling or currencies weren't able to anchor themselves to gold anymore. There was a shortage of gold and various other problems, but this was a period of economic chaos. The picture on the right-hand side is actually a woman loading her stove full of money, because it was cheaper than the firewood that she could buy for it. So that's in Germany in 1923. So governments basically went into an isolationist thing and so-called beggar thy neighbour policies, where they would use their interest rates to try and attract capital, to try and make their exports more competitive. They would print money to pay their bills, and that would lead to enormous inflation, as you can see on the right. There was also a period when sort of global free trade had collapsed. There was no sort of gold standard anymore, and currencies freely exchanged. Now, the combination of that with governments being irresponsible, or sort of internationally irresponsible with their policies, meant it was always very, very risky to ever accept payments in a foreign currency. So, because by the time you got to put it in the bank, the value of it might have halved or something like that. So there was very little trade. What trade there was in imperial blocks. Like the British Empire used sterling as their standard currency, and there was a lot of trade going on there. Similarly with the French Empire, but in between there wasn't. All this led to the Great Depression of 1929 to 39. An American sort of stock market bubble collapsed, and with all these international policies going on, and there was basically the longest or a very, very long and memorable depression, when you had enormous tent cities all over America. You had up to 20% of people unemployed, and basically you had economic ruination. After the Second World War, then, there was what's known as the post-war settlements, and this was a radical change in economic orthodoxy. We saw the foundation of the welfare state, for example, in Britain, and eventually in many parts of the world, and even in the United States. You had a lot of the elements of the New Deal being implemented. This was basically a capitalism sort of trying to buy off the militancy of labour, particularly with the Cold War and the Soviet Union appearing very strong at the end of the Second World War. Capitalism was basically on the back foot. This new economic orthodoxy was the sort of brainchild of John Maynard Keynes, known as Keynesianism, and its central tenet was that there was much greater, rather than the laissez-faire of the 19th century, there was a very, very direct government intervention in the economy. For example, one of the tenets of Keynesianism was that in a recession, the government should increase spending, because you can only get out of a recession by spending your way out. Also, very active use of the interest rates to control the money supply. But there was also much greater regulation of banking. So to some extent they learned the lessons from the depressions, and they very much want to avoid these because they were bad for capitalism as well. And they realized that banks were sort of short term. They would make reckless risks and reckless loans, and we're going to have to regulate them to prevent them from doing so. Now, the international order at this time there's a meeting in Bretton Woods, which is a small town in New Hampshire. That's Keynes and Dexter, the American sort of architect of their sort of slightly social democratic policies post-war. But Bretton Woods basically was a meeting in 1944 by the leaders of the Allies. As soon as they knew that they were going to win the war, they got together and sort of said, okay, we're not going to allow this economic chaos to happen again. So rather than having these free-floating exchange rates, they fixed exchange rates. Basically, the US dollar was linked to gold and everything else was linked to the dollar. they established the first international financial institutions, the IMF, which is the International Monetary Funds, and the IBRD, which sort of morphed into the World Bank. That's the International Bank of Reconstruction and Development. But as well as these type of things, this isn't like the modern IMF world. They explicitly incorporated many areas where governments could control the economy. So the governments could control capital flows. You could only take so much money out of the country. And that used to be in Ireland. If you took more than like 100 punts out of the country, you'd have to fill in forms, even going on your holidays back in the 1970s. And in the post-war period, and these were all sort of, they were to appease the growing militancy of the working class, but also to stabilise their economies. Just from a purely capitalist point of view, depressions are no good. So if we look at the effect of the settlement, this is the income of the top 10%, the 10% of wealthiest people in the United States, what share of the income they get. And you can see when this post-war period came in, it's actually during the war that you get the real shift, but it follows through after the war. You get a sudden drop-off in the amounts, and this is a very good sort of way of seeing the concrete effects of these things. Capitalists got less of the proportion of wealth, and so on. Now we can see at the end there, things start to go up again, and that is, we got neoliberalism arrived on the scene. And it's basically a capitalist counterattack against 1960s radicalism and anti-imperialist movements. The Americans had just been defeated, essentially, in Vietnam. They saw that there had been the huge upsurge of 1968, 69, and they saw themselves in trouble. They said, if we don't do something, we're going to be eliminated. So this is really where neoliberalism comes from. The economic milestones of neoliberalism now. The 1960s saw the growth of the unregulated euro-dollar market. This was mainly between American banks based in London, and basically they were loaning money to each other, and the important thing about that was outside of the regulated system. So the banks were, and capitalism was reasserting itself, trying to get around any type of state control on it. And from that 1960s thing, it's still probably nowadays that has followed through to currently the most important interest rate isn't set by the governments, it's set by those banks. It's called the LIBOR, the London Interbank Offered Rate, and that rate, that's one of the interesting things that has caused the current crisis. Anyway, so in 1973, then, US collapsed the exchange rate mechanisms of Bretton Woods. They basically just unilaterally pulled out and refused to pay their debts. They tend to do that. In 1979, there was a thing, this guy on the left is the American Treasury Secretary called Volcker. There's the Volcker shock, when the Americans, basically, what they did was they did a short-term sabotage of their own economy by incredibly increasing the interest rate. So it sort of destroyed the real economy, but it also destroyed a lot of the sort of governmental controls. And a lot of it reversed a lot of the trends in wealth in the world. They increased the interest rates. They put them up to around about 20%, I believe, basically attracting a lot of capital into the United States, but also increasing the amount that the third world couldn't pay back. So in the early 80s, you had this big debt crisis as third world governments who had depended on borrowing from the wealthy countries came back to renew their debts, and they were having to pay 20% per year on them, and that was unsustainable. So you had a huge collapse of third world economies. Then the next big milestone for neoliberalism was the end of history, which is the collapse of the Soviet system in 1989 and 90, and that ushered in an area where you basically had a unilateral US world order. Before, say, the First World War, you had a very liberal sort of laissez-faire system, but it was sort of to agreed things, and there was multiple powers. In this period, the United States was really the only global power. The political champions of neoliberalism, there in the middle is Friedman. He was the sort of economist from Chicago who was the intellectual sort of doyen of neoliberalism. On the right and left we have Thatcher and Reagan. And then Small, who doesn't normally get in the front of time with them, is Pinochet. Pinochet's coup in 1973 was really the first neoliberal experiment when they really applied these things. And what is neoliberalism then? Well, the basic thing about it is, first of all, deregulation of capital. And this is, we take away any rules that allow wealthy people to do whatever the hell they like with their wealth. That's the guiding principle. Just, they can do whatever they want. Okay, and that ushered in a credit and speculative explosion, because there had been all these rules to stop these financial institutions becoming unstable and so on. They got rid of all of that. It also, a big part of it is globalisation, okay, which I'll go into a little bit more detail. But at its heart, neoliberalism means it was a bit different than 19th century liberalism, because whereas you had laissez-faire for the poor, you got also welfare for the rich. The state was used repeatedly to step in and save the wealthy people who had gambled recklessly. So there has been, again, predictably, with the return to sort of much more unbridled and unregulated capitalism, you had a whole succession of crises. There's the 1987 stock market crash, Mexican crisis, there was the Asian IMF property-related crisis, there was the collapse which had to be bailed out of long-term capital management, an American hedge fund, there was the internet bubble, there was Enron, WorldCom, 9/11, there was also stock market collapse then. And all of these things, the man there at the bottom is Alan Greenspan. He was the Secretary of the Treasury, or no, he's the Chairman of the Fed, the Federal Reserve, and which establishes American monetary policy. And the thing that was common to all of these things is the Greenspan put. Whenever there was a crisis, you just drop interest rates the whole as low as possible, often down to zero or thereabouts, basically allowing people to borrow more money and making that more attractive. And so it was a way of, whenever there was a bubble was trying to deflate, he would try and re-inflate it. And so, whereas they had been able to, for quite some period, to get through these type of crises, they were essentially just building up a bigger and bigger bubble, which was always about to burst. And so we can see there's also, if we look at this, what globalisation means, one big part of it was outsourcing to poorer countries to cut labour costs and an attendant economic restructuring. You can see that the dark line here is the profitability of American financial companies, and the dotted line is industrial ones. And you can see there from the 1980s they started diverging wildly as America basically became a country whose dominance was dependent on services rather than manufacturing. Okay, and a lot of the stuff is manufactured in the third world. To do this, because America was getting so much of its goods in imports, they had to borrow hugely from overseas. Now, the black line there, the middle, horizontal middle, represents like you borrowing nothing. You can see there from like 1980, there was a brief interlude for the Clinton government when they started paying back their loans, but the Americans are borrowing like 500 billion a year, say, off the combined European and developing countries, and that's quite a lot of money. And that's their sort of that's by other countries buying American government bonds and stuff like that. So America's big expansion has been a lot of it on borrowed money. Now, all of this, because the Americans, because they had very wide supply chains and dependent on all sorts of resources, it all depended on the military and financial hegemony of the Yanks. That you can't have a supply chain where you're getting oil from the Middle East, you're getting cars from China. You can't, to have that, it's very fragile. It can break. There's so many places it can break. So it depended on America being able to send troops there when anything broke down, when anybody said, hang on, we want to charge you more for this oil or whatever. America could send troops there and blow them up. Now, what all this neoliberalism meant was that we got a huge rise in inequality, whereas the previous period in the post-war settlements, inequality had decreased. It now hugely increased. So the top 1% of Americans between 1979 and 2004 saw their incomes increase by 176%, the bottom fifth by 6%. So even though with extra productivity and technology, and that's a period of very intense technical innovation, almost all of the benefits of it went to the top 1%, and less so as it goes down the pyramid. So this all leads us to the crisis of 2007. Now, the first thing to note is that, according to all the people who know the most about it, this is a really big thing, and they're probably right, as we'll see. The head of equities at a large UK bank said it feels we're 15 minutes away from the end of the world. Bush said in typically sophisticated manner, if money isn't loosened up, this sucker could go down. And Warren Buffett, the world's wealthiest man, called it an economic Pearl Harbor. So to understand what's going on, we just have to do a little bit more into a financial background. First of all, liquidity and liquidity crisis. A lot of people you'll see in the mainstream media are referring to this as a liquidity crisis. Liquidity is just having cash flow, essentially, being able to pay your bills when they come in. So you can have a liquidity crisis without, you can have lots and lots of money, but maybe it's tied up in mortgages or something like that, and somebody knocks on your door and they want your credit card bill paid. You've got millions in mortgages, but you don't have any money to hand to pay that. That's a liquidity crisis. Now, to get around, there have been rules of for banks, as I said, because banks loan out much more capital than they actually have. There is rules that they have to have a particular amount of capital reserves. Now, if they have a particular amount of capital reserves compared to their debt, then they're solvent. The business is considered basically good. Now, this is all made slightly more complicated by the fact that you're not just looking at loans and deposits or assets and liabilities. Every loan that you give out has a certain amount of risk associated with it. So dependent on how risky your loans are, there is a certain amount of capital reserves you have to keep, and that's known as CAR, capital adequacy ratio. So a solvency crisis then, which a lot of other people in the mainstream media have been saying that this crisis is all about, is just you don't have enough capital to sustain your debts. And the thing is, they're actually correct. If you look at any of the big American banks, they're between 30 and since deregulation of one particular law in the 90s, their debt to equity ratios are like 50 to 1 and thereabouts. So you're talking that of the capital that the bank owns, they have loaned out 50 times more than that. And so, as we'll see, that has become unsustainable. So another little look into the financial world is to look at what derivatives are. So derivatives are basically, their name comes from the fact that they derive their value from some underlying asset. And derivatives are sort of purely speculative things. They're just links to the price of some equity, bond, exchange rate, loan, index, and mortgage, and pretty much anything. You could have a derivative based on the number of twins born in Ireland this year, and somebody would probably, and they're gambling on numbers, essentially. There's some of the different types are forwards, futures, options, bonds, and there's a whole range of other sort of financial instruments. All of them are essentially, what's important about them is they don't require you to own anything. You might have a derivative or a future on a company, but you don't own any of that company. You're just basically gambling on particular movements in its price. They do have sort of particular uses, these type of things. It's not just random gambling. So one of the big uses is hedging. Okay, so hedging is trying to cover both sides of a risk. So for example, let's say I think the price of a stock is going to go up. I buy some of that stock. Now I realize actually I think that's a bit risky. I'm too exposed to risk here. So what you might do is you might buy futures of that stock at a different price and say, okay, well if the stock price goes down, I'll have these futures at a different price and I'll be able to make money back from that. So that's hedging your bets, betting both sides of any type of movement. Arbitrage is, let's say if there's a significant difference between the price of a commodity in two different markets. I'll buy in one place and sell it in another. And then just pure speculation. There's various other sort of reasons that banks and financial institutions got into all these derivatives. One is that theoretically they're more liquid than, say, stocks. You can sell on these future markets all the time. A lot of stock exchanges are only open weekdays, for example. You have electronic exchanges that go permanently selling these type of things. Also, they tend to be larger markets because they're infinite. You can have as big a derivative market as you like, whereas there's only a finite amount of stock. So people put money into them because they're thinking, okay, if things go bad, I can sell them quicker. That was one of the big reasons, and that was one of the reasons why this crisis has been so bad, because everybody did it. and if everybody tries to sell at once, nobody can sell. So the hedges all broke. So in recent years we've seen the emergence of a whole lot of financial exotica as well, and these are things you've probably heard in the media a lot about. Collateralized debt obligations. That's basically I have some type of collateral, and you loan me money on the basis of that, and if I don't pay you back at whatever type of interest rate, I get your collateral. Okay, credit default swaps is basically gambling on whether a company or whether a company will default on its loan. So, so if their form of hedging. So, for example, if James was to loan me 10 grand, okay, which would be pretty foolish, so he'd go and drink it straight away. And then he got worried, oh geez, I don't know if that bastard's going to pay me back. He could take a credit default swap out with a trader to say, okay, well listen, here I'll give you a premium of 100 quid, and if Chekhov fails to pay me back, you have to pay me back instead. And the trader of the swap is gambling that I'm not going to drink it, that I will pay James back. There's also things called structured investment vehicles, conduits, and these are generally things set up by banks independently of themselves, like independent companies set up to allow the bank to do various trading outside of the regulated system. And then you got all sorts of very strange things like synthetic CDOs, which they're only based on other CDOs, or sort of based on assets randomly picked from across the world and just linked to their price. They don't actually have collateral directly attached to them. CDO squared, which is derivatives on the prices of CDOs, cubed, and so on and so on. They go infinitely. And the way that all these type of things, the CDOs in particular, work is you take, let's say if you're a bank and you've got 1,000 mortgages, you say, okay, I want to use these, I'm going to get paid back in 30 years for these mortgages, can't do anything in the short term, I want to free up some capital. So what I'll do is I'll sell them on. So I'll take 50 of these mortgages and wrap them up as a single bundle and come up with a very sort of sophisticated and different way that people can buy slices of that. Okay, and so you could buy a slice of mortgage, but you get paid back over 10 years rather than 30 years, and there's lots of various different ways and different ways of pricing them and so on. Anyway, all of these type of instruments, so the creation of them saw, and the deregulation of the global market saw huge capital flows, enormous capital flows going around. So in 2000 the credit default swap market was $630 million. In 2007 it was 62 trillion. Now just for comparison, the global GDP last year was about 53 trillion. So the 62 trillion invested in those is of greater value than all the human activity on Earth for over a single year. If everybody got down and worked for a year, you still wouldn't have made that much on the whole planet. There's things like the money market is that the extension of that 1960s Eurodollar market. It's banks loaning to each other. Technically, the way the economy is conceived is banks borrow money from the central bank. The central bank prints money, the banks borrow it from that. But there has been an explosion in the money market. Then there's hedge funds managing about 10.5 trillion in 2007. By comparison, all the stuff within the regulated system. And whereas there has been deregulation, there still is some significant regulation around banks. There isn't regulation around all that other stuff. Like if you're a hedge fund, you can do what the hell you like, really. So there's fundamental problems in this, okay? The biggest one is risk multiplication and coherence. And this isn't even, it's important to get that these aren't sort of radical critiques. These are things that are well known within capitalism. That's a quote from Warren Buffett, the wealthiest man in the world, and who's basically invests particularly in insurance. And this was back in 2002 when he's saying large amounts of risk, particularly credit risk, have become concentrated in the hands of relatively few derivatives dealers. Some of these counterparties, as I've mentioned, are linked in ways that could cause them to contemporaneously run into a problem because of a single event. Derivatives are financial weapons of mass destruction, carrying dangers that, while now latent, are potentially lethal. And it's funny, one of as I say, the short-term focus of capitalism is pretty amazing. When you've got somebody so within the system who understands the market so well, saying these type of things like 6 years ago, and everybody ignores them. It's not a good sign. Anyway, Some of the other risks with derivatives is, for a start, the complexity. This is how you price a CDO down beneath its a Gaussian copula, and that's how you price the various tranches. Very few people, obviously, are going to have a very good handle on what the hell is going on there, what they actually own, and how much it's worth, and so on. And the other thing is information imbalances. Now, one thing that's very interesting about the current crisis is that lots of people just don't know who has all these dodgy mortgages. And the reason being for that is that capitalism, is a system whereby nobody plays fair. Everybody's a liar. So the people who are selling on their mortgages to the CDOs, and they're normally called CMOs, collateralized mortgage obligations. Basically, if you're a bank and you're saying, okay, well, I want to sell on 50% of my debt, you're not going to sell them on your good ones. You're going to say, well, okay, I know that a glue factory is going to be built next door to that place. I'll sell that one on. Okay, I know that dude's an alcoholic. I'll sell that one on. And so there was a whole lot of all that information at the low level that the bank would know about because they actually have met the purchaser and loaned it to them. They're not telling the guys that they're selling it to. No fucking way. They're saying, yeah, the fundamentals in this guy are great. So, and they always have more knowledge that you can't sort of get in numbers like that. Oh, I know that that's full of crime. The person who's buying it, it's just a number to them. They can't see that. So the other thing about derivatives risks is there's actually limits to debt. Like debt can't build up forever. There is a thing, it always has to be attached to somebody doing something, okay, producing something in some way eventually. And so when debt tends to balloon like this, we see there's the pyramid of society on the right. The people at the bottom start getting squished because they're the ones who are actually doing the work, and they can only sustain so much debt. Also, from the United States' point of view, this particular neoliberal explosion, there was a huge amount of dependence on foreign capital, as we saw, and also just foreign resources. A lot of stuff coming from overseas, and that can be vulnerable. Then, when you add into it an extreme amount of corruption and complacency within the governments, and there on the left with Cheney, Paulson, the Treasury Secretary, and Bush, and Gordon Brown. There's a nice quote from Gordon Brown: "There will be no return to short-termism, no return to Tory boom and bust," in 2007, just before we saw the biggest bust in the century, or in 100 years practically. And a lot of this, like, if you look into the details of the current crisis, a lot of basically the information is not getting out there because there's corruption everywhere. So accounting practices within corporations, their books are often quite fictional, so nobody can really see these things coming. Also, there's one of the very important elements in the American capitalism is the rating agencies that say how creditworthy a company is. These credit agencies they gave AAA, which is their highest rating, to a lot of the dodgiest of the loans. And so they weren't, because, and again, that a lot of these guys are interested, like the Cheneys of the world, in basically using the government to loot rather than, they don't give a damn about capitalism. They're just in it for themselves. So this brings us then to the actual trigger of the current crisis. It's this subprime bubble, and in 2003, 2004, there's a huge amount of capital flowing around looking for great returns. And you can see when you start seeing mortgages offered with hair, nails, and gifts, and roadside signs saying 100% financing, zero down, that we're probably going to hit trouble here. And the background to this was that if on the left-hand side we can see that's the amount of household debt to personal disposable income. From 2000 on, it's gone over 100% and is climbing rapidly. So at the bottom of this is like the people on the bottom row are hugely indebted. So that capital, even though it's looking for people to loan to, people are actually practically insolvent. On the right-hand side, we have personal saving rate. And we can see, so again, historically, you could have found it as high as 10%. People were saving, as much as 10%. We can see since 2000, it's down 2-3%, and then it goes negative in 2006. People are actually, on average, not saving any, but actually going into credit, on a greater credit on average of their income. you know, you have a population with a very, very poor credit profile here. People are trying to find ways to loan to them. So what they came up with, subprimes were, you know, a very stupid idea. Like, and it's amazing to think that the entire financial system bought into them. So what you're saying is, you're saying, I will loan you the value of that house, even though I know you can't repay it. I'll set a very low interest rate initially, so you might have to pay only 1% for the first 3 years, but then suddenly it'll increase to like 10 or 15%. And what happened was, as soon as the initial times went out, everybody started defaulting in really large numbers and weren't able to pay them back. And that seems really obvious, like, but this is what happens in bubbles. The capitalists start getting stupid. Now, when I said here at the start, one of the fundamental flaws of capitalism is that people tend to think things that have always, or that have been a certain way for a period of time, are always going to be that way. And here it was house prices. So the banks were all saying, okay, well, they're going to default after 3 years. They're not going to be able to pay their mortgage, but their house price will have gone up. So we'll just take their house back and then sell it on again at a profit. Okay, and so the obvious problem there is a whole load of people suddenly at the same time default on their houses. That's going to force house prices down, and then everybody's in trouble. So the subprime, how these mortgages sort of spread to the rest of the thing. For a start, the banks that were loaning these people these crazy-ass mortgages were securitizing them and selling them to CMOs. So taking like the 50,000 mortgages and selling them on as a bundle in these collateralized mortgage obligations. And then the people who were investing in those were hedging that they weren't going to be able to pay their debts back with these credit default swap stuff. And and because those are such enormous markets, it spread throughout the entire global economy. So at the limit of the bubble, actually the Dow didn't top out in July 2007, but this is when it closed above 14,000 for the first time in history. And this is typically what happens in bubbles. You know, everybody, right at the limit, people are like, Jesus, this stuff has never been so good. Look, we've totally forgotten about, you know, all that old busty type of stuff. It's onwards and upwards. And then 2007 came along and lenders started defaulting in large numbers. These subprime mortgages started maturing. August 2007 there was 100,000 US foreclosures. That's banks taking people's houses back. September 2008, now that's last month there was 250,000. Now those are really enormous numbers. It would take like, you know, 6 months. If we had that rate in Ireland, the whole country would be out of a home. You know, these are very, very large numbers, and each of those might, you know, best part of 1 million per. So you're talking very, very, very large numbers. Those 250,000, if you multiply them by the price of all of their houses, you're getting into the trillions pretty quickly. Okay, so August 2007. Then, with this all going on in the background, all these foreclosures going on, there was the credit crunch. Okay, so all the banks were starting to say, and they were saying, oh my God, the prices of these mortgages that we own are falling. The people aren't going to be able to pay them back. We've got a huge hole in our books, and all the other banks have holes in their books. So there was basically almost overnight, there was a re-evaluation of the entire risk for all loaning across the economy. So it went up, like the LIBOR suddenly, which is the interbank interest rates, it went vastly different from the actual ones offered by the central bank. So banks basically stopped loaning to each other. Okay, so because this LIBOR and this easy credit had been in existence for so long, people had become dependent on it. So the typical business model in the 90s and 2000s was dependent on companies being very heavily indebted and borrowing short-term funds, borrowing always to pay off their debts as they went along. This is known as heavily leveraged. And the big thing here was, as soon as this credit thing came off, that business model just stopped working. If you had a lot of debt, you were just in trouble, because you weren't going to be able to borrow money to make the payments on it. And banks started to fall. September 2007, Northern Rock was nationalised by the British government after a bank run due to it had a whole lot of subprime exposure. The financial turmoil continued in March 2008. Bear Stearns, one of the 5 sort of old investment banks of Wall Street, which were the sort of flagships of the whole American economy, it collapsed as well. it was basically heavily exposed to subprime CDOs, and it was collapsed and bailed out by the federal government or the Federal Reserve and JP Morgan Chase, September 2008. Fannie Mae and Freddie Mac were nationalised. They're the guys who bought from the banks, directly from the banks, mortgages, and they had about 6 trillion exposure, which is again a really, really large number. The entire US GDP, for example, is 13 trillion. So that's like half of the entire output of the entire United States over an entire year. The Merrill Lynch then, on the 14th of September, Merrill Lynch was bought by Bank of America. It had just announced a 51.8 billion loss on the subprime market. And then the big thing was on the 15th of September. This was the one that really, once Lehman Brothers collapsed, this really sent the whole system collapsing down around it. It had large holdings of lower tranche CMOs, which is pretty much the shittest thing you can have. They were CMOs. These type of debts are tranched so that you can buy at different levels, and the lowest one means that if there's any defaulting, I'm the guy who loses out first. So they had a lot of that. So when they collapsed, they had debts of 768 billion and assets of 639 billion, and that's an obvious big hole in the middle. And they were simply unable to finance the payments on that. They weren't able to borrow from anyone else, so they have to, and the government allowed them to collapse. Now, allowing them to collapse set a whole systemic collapse in motion. It was Ronaldo did it, actually. But AIG was the biggest, it's the biggest insurance company in the world practically. So, but it was the main player in the credit default swap market, and so basically people had hedged somewhere between 100 and 400 billion. No one knows yet. It's next Friday, I think, the auction of these happens, so we'll find out then. Backed, basically saying, if Lehman collapses and isn't able to pay me back, they had 100 to 400 billion, which is bigger than the amount of debt outstanding that Lehman's had. This is the multiplication effect of these things. So what happened? The fall in house prices and triggered the rating agencies to downgrade them. A lot of the collateralized debt obligations say, well, if you're downgraded, you're going to have to post more collateral because now you're dodgier and I want more. And so they weren't able to, they were demanded 15 billion was demanded of them. They weren't able to raise it. And they, again, they were on the verge of declaring bankruptcy, and the federal government stepped in and gave them a 85 billion loan. Then, in the background of all of this, we had a market collapse. So the market, which sort of ignored the credit crunch for a while, stopped. If you remember, back in July 2007, it was about 14,000. Here in September and early October of this year, the last few weeks, it's lost about 25%, but it's down. We're getting towards where it has lost 50%, and that's basically people saying, well, the American economy is now half as valuable as we thought it was a year ago. The 21st of September, Goldman Sachs and Morgan Stanley, the last two remaining investment banks on Wall Street, and this is a real epoch-defining thing because that was the centerpiece of the American economy, the investment banks. They ceased being investment banks and became ordinary regulated banks to because that would allow them to have access to the federal government funds because they needed those to pay their bills. And we had the worst week ever of the stock markets. Then we got to the bailouts. Now these are ongoing, and we've seen in the United States there was in October, at the start of October, there was a 700 billion bailout fund. The total US bailouts money that they've made available to bailouts at the moment is probably about 2 trillion. Again, these are trillions. Again, you can get sort of these things are hard to put into context because they're such big numbers, but once you're talking in the trillions, everyone has trouble paying back trillions, you know. Germany threw 500 billion in, again half a trillion, that's a lot. There's a coordinated interest rate cut across the world. There's a wave of global bailouts and nationalisations. The Irish government has given a guarantee to all interbank lending and deposits to all their banks. We don't know how many billions that's going to cost. It'll cost at least a lot of billions. And again, that's an awful lot. If remember, the structural funds that Ireland got from Europe was about 14 billion in total, I believe, and you know, that basically built a lot of the infrastructure of the entire country. When they're sort of giving the banks billions, that's an awful lot. Iceland, the entire country collapsed. Iceland's economy had basically turned itself into a big hedge fund. It's completely deregulated and stuff, and that just completely collapsed. They had to nationalise their 3 largest banks. The question now is, will those bailouts work? What are the prospects of a recovery? Now, for a start, we can see the credit markets are still frozen. They're slightly less frozen than they were. The LIBOR has come down ever so slightly, but banks still won't loan to each other. They think they're still too dodgy, so that will take an awful long time to fix, if it is fixed. Many companies are massively, the word under is missing there, but massively undercapitalized. And what that means is, because there was this business model, neoliberal business model, where you try and take on as much debt as possible and repay the interest in that debt and use the money that you borrow to make bigger profits. There's a lot of companies that are what they say leveraged, like to the tune of 50 times, 100 times even. They have 100 times more debt than, or you know, 99% of their capital is debt, and they're just depending on that they'll be able to borrow cheaper than the amount of money they can make with that borrowed money. Now, when the markets completely reevaluate risk, that whole business model is broken, and so, for example, General Motors faces bankruptcy. They weren't able to borrow the money to build their cars last month. They have a very sort of just-in-time financial model where they try and figure out how many cars we're going to build this month depending on projected market value as close to time as possible and borrow that money. They weren't able to get it. So they had a lot of plants just sitting there idle because they weren't able to borrow the money to do that. United States employment has been skyrocketing, hit 6.1%, and it's only going up. And all of this, we have to remember that these bailouts, they're coming from the government, and the government itself can only bear so much debt. The United States itself is highly, highly indebted at this stage. It has approximately, according to CNN, 53 trillion in unpaid debts or uncosted spending, and that is in and around global GDP. Okay, so, and it's much, much, much greater than the United States GDP. So it's uncertain how long that can go on. We could have a collapse of, for example, of the Americans' credit rating and a collapse of the dollar, and that would really lead to total economic collapse and chaos. So what's likely to happen then? So one of the things that we can guarantee will happen is the whole disaster capitalism thing. Capitalism, modern capitalism, whenever there is an economic crisis, they basically say, okay, this is a really good, we can go on to everyone about how we're in such trouble, we're going to have to cut your wages, and, you know, and all sorts of things like that. So cutting public spending to fund these debt. And also the state has taken on a huge amount of debt, and so it's not just, in this case, they're not crying wolf for nothing. There is a fucking wolf at the door. And they have just taken on all this enormous debt, and they have to make repayments on that. So, for example, you saw the government announce that they had increased spending by like 6% in this budget. A lot of that is just to pay the debt. They actually didn't really increase spending. They're just because they have such a much larger debt, and because they have a lower credit rating because they took on all the bank's debts. Their lending is much more expensive. So in the Irish budget cut, we have no idea how much liquidity they have given the banks. We'll only know, like, you know, a few years from now. But certainly it's billions. So sort of gave 1.69 billion for property developers, and at the same time they took medical cards away from pensioners. So that's the type of thing that we're going to see, and that's not a good thing, obviously. And will there be depression? Okay, so according to a CNN survey, 59% of the US public think a depression is likely. And a depression is, we're talking basically economic devastation where everyone loses their jobs and there's vast numbers of homeless people and so on. And unfortunately, it's probably quite likely, because all these companies that are so indebted and that are basically have business models based on large amounts of borrowed money, that's not sustainable. They're not going to be able to borrow that. So anything, they're going to have to scale back all of their enterprises. They're going to have to shut factories that require borrowed money, and so industry is going to contract. Public spending is under pressure. You see, at the same time, the state has taken, in all these countries, has taken on so much debt. So the traditional way of getting out of a recession is for lots and lots of spending on public works, for example, employ people, allow the state, make the state indebted by spending on that type of thing. You can't do that if they've got such a big debt already that they're spending so much money to finance it. So that's not really a viable way out. And property will probably keep falling for at least another few years, and then remain, if we look at historic patterns, it will remain in a trough for probably 10 to 15 years thereafter. So property there's not going to be a long-term property recovery anytime soon. Banks are just going to be much, much slower to give credit in the future because they've lost such vast sums on this, and without credit it's hard for an economy to recover. You know, people need, even to set up businesses and stuff like that, people need credit. But, so a depression is quite likely, and that's not a good thing. But on the other hand, there are some political changes that are good. For the first time really since 1989, since the end of history, free market, the ideology of free markets, that capitalism works everything great and free markets are the way to do everything, has been shattered, completely shattered. We can see people like Sarkozy saying, you know, going on about how the markets don't work. Gordon Brown was saying it today, that this has revealed it. All these people who, you know, loved the markets a few weeks ago, they're even saying Alan Greenspan, the chairman of the Fed, who is the most right-wing and sort of free market ideologue ever, he came out there a couple of weeks ago and said we thought that the era of ideological debates between socialism and capitalism were over. We were wrong. We're back on it. You know, so all of these people, they are probably actually, they give us socialists, they're more afraid of us than we are, than they should be, probably, at this stage. No, but they see it very directly and immediately as this is a huge, huge ideological blow to us. When all the banks and when all the investment banks collapse and they go begging to the government on their knees for a dig out, it's going to be very hard for them to recover that type of prestige. Also, the government's response to it exposes the class structure. Again, when you're sort of chopping pensions and all sorts of stuff like that to give billions to bankers are never very popular at the best of times. People are like, oi, and it reveals the underlying class structure of our society. Finally, we'll just, this is the very last slide, look at some of the geopolitical changes, because this crisis throws up a this is a dangerous looking Russian guy, but this crisis actually throws up a whole lot of interesting changes in the world and the way it's worked. And so the whole US post-1990 global hegemony, where they basically did what the hell they liked, and screw you guys, is significantly weakened. First of all, their multi-trillion foreign debt. So China has been buying, throughout this period, the United States has been financing all of these bailouts through issuing government bonds. The Chinese government has pretty much been buying all of them. One of the Chinese governments bought 49% of one of the big investment banks. I think it was Merrill Lynch or something like that. Was it Merrill Lynch? Morgan Stanley, yeah. So that is really significant because, for example, if we have a future confrontation between the United States and China doesn't have to fire a single bullet. It just has to say, okay, we're selling those bonds, and the dollar will collapse, and the United States will pretty much have to declare itself bankrupt. Okay, so now obviously China doesn't want to do that because China has America is China's main foreign market, and it wants to sell stuff there, and it doesn't want the American economy to collapse. But in potential conflict circumstances, it certainly has a lot of leverage now, a lot more leverage. Lots of other places also suddenly have a lot of leverage over the United States. And you can see this while all these crises have been going on. Over the summer we had Russia in Georgia. Now, I think it was unthinkable even a few years ago to imagine some, NATO saying, "Hey, we really don't want you to do something like that," and them being ignored. But what happened in Georgia was the Russians just completely ignored them. NATO was unable to do anything about it. So also, and a lot of this as well, a lot of these economic crises have their roots in other stuff. Like the American government, as I said, like their global hegemony was very much dependent on being able to intervene around the world and sort of beat people up who weren't playing along with their goal. But their troops have been tied down in Iraq and Afghanistan. Okay, they're fighting wars they can't really win, wars of occupation. And they don't have a lot of excess people. So when the Georgian crisis happened, you know, they eventually got around to sending some ships there. It took a couple of weeks, but they couldn't really even, you know, they sent a strongly worded letter, and Russia was able to say, well, what the hell are you going to do about it, you know? And they were saying, oh, Jesus, we don't have, all our troops are already fighting wars. What can we do? So all of this might combine to see a new period of imperial competition, like in World War I. We've got, for the first time in a long time, we've got a number of sort of power blocks, Russia, China being one, also in South America and Brazil, being the strongest economy, but a few other economies that are becoming quite independent of the United States. And the Americans, as I say, are weak on a number of fronts compared to what they have been. And so the world is changing in interesting ways. Now, these ways aren't normally good. The last period of that type of imperial competition ended in World War I, which was just an enormous pile of bodies, and, you know, that's always a possible outcome. But it does, at least from our point of view, it removes this sort of untouchable and unstoppable global power that can sort of run around the world, kicking the shit out of whoever it likes. So that's the end of the talk. And now I haven't. There's various other sort of things, particularly in terms of that we could talk about in terms of how socialists and leftists can take advantage of this. But I wanted to sort of keep the talk more on the focus of actually trying to give people an understanding of what the hell happened. So that's that. Thank you very much.